It's Brian Preston, the Money Guy.
What has actually happened historically with all the presidents since the 70s to now and the stock market, meaning the S&P 500?
And in true FTE Daniel fashion, he did a much better job than I did. His looks a lot better. And this, I think, is so interesting. If you notice, since 1977, we've had Republican presidents, we've had Democratic presidents, we've had Republican Congresses, we've had Democratic Congresses, and it's really, really interesting. If you're out there listening in iHeartRadio, iTunes, Stitcher, Spotify, you ought to go to YouTube to see this chart, because what we have outside of each president's term is just an overlay of the S&P 500 and what it has done since 1977 all the way through 2020.
Well, what I think, if you take the visual, and I want to describe this kind of like a sportscaster does, so you that do not have the visual can understand, is that the first thing I notice is that there's a lot of green on this slide, because what we have here is we have the total return as well as the annualized rate of return for every president since President Jimmy Carter, the peanut farmer from Georgia.
That's right.
We have some affinity for him. And here's what's interesting. Everybody has been green, meaning positive, except for President George W. Bush. Now, here's something I think is interesting, Bo, and I talked about this during show notes. Before we all feel sorry for President Bush, I think he has done the most baller thing that you could actually do.
All right.
He has tagged this graph.
What do you mean he's tagged
What
it?
I mean by that is if you look, what happened at the very beginning of George W. Bush's presidency?
It was dot-com bubble bursting, September 11th.
So we had two big things happen, and then right at the end of President Bush's term, we had the whole Great Recession of 2008. So if you look at this, and I tried to get Daniel to actually do this on this graph, he has, I couldn't believe it until I actually saw it, and once you see this, you'll never be able to take it off. He put a W right in the middle of the S&P 500 chart. Because if you notice, and this is the other thing I want you guys to notice, and this is going to be the theme of today's show. Yes, presidents matter. Yes, tax policy. Yes, spending of all government matters. But in the grand scheme of it, it looks like markets go up over the long term pretty good, whether it's a Democrat in office, whether it's a Republican in office, and we're going to go even deeper on that, and that probably is a great segue, because look, there's several different scenarios you can approach, and wouldn't it be nice if there were some data points we could put with this? Let's look at what does it look like just for Republican presidents all the way through to 1789, I believe. This is what we would want. And what about Democrat presidents? What if we had a split Congress, meaning we had gridlock where you had a Republican or Democrat president, and then you had Congress be something completely different, or if you had just where they win in a sweep and they're all powerful. Now, you were pretty quick on flipping that chart over, but what did we find from our research?
This is what I think is really interesting. Like you said, if we go back to 1789, looking at some composites, whether it's the S&P 500 or the Dow Jones or the Cowles Index, overall performance on an annualized basis, market made about 9.1%. That's the overall. Well, if you look at it, a Republican president versus a Democratic president in any of those years, it's either 8.6% or 8.8%. So really, really close. Not a whole lot of difference. If you look at a Republican sweep versus a Democrat sweep, meaning president as well as Congress in the same party, 8.6% versus 8.2%. And then what I think is really, really interesting, if you look at a divided Congress, Republican divided Congress or Democratic divided Congress, it's 8.7% or 10.9%. What I see here is, by and large, all those numbers kind of hover pretty close together. It's not like one of them's 12, 13% performance and the other's like 3 to 4% performance. They're all pretty consistent.
Politics in general are very emotional. And I think that it's good to have charts and data like this, because, guys, they let you step above and beyond just the raw emotionalism. And by the way, all the industries that are taking advantage of those emotions right now are on full alert. They're front and center. They're in front of you. They're in your ears. They're in your eyes. You need to take a step back and realize what really drives economies and markets in the long term is corporate earnings. Interest rates, just where the economy is in general with labor growth, productivity. Guys, this is what's important. And I'm thinking about it right here on the spot. Wish I'd have told FTE Daniel to put it. we have that great chart that we had Daniel put together that basically shows how if you look at the financial markets over the long term, it visually looks like you're walking up an ever-growing mountain with a yo-yo.
Yep,
and what I'm saying about that is that realize with a yo-yo, yes, you're throwing the yo-yo up and down in the short term, but as you walk up to higher and higher elevation, your portfolio will be better. And I'm going to close today's show out with something that will kind of take you outside of politics, outside of election cycles, and let you know what's really driving what's going on in your portfolio in the long term. So don't let the noise derail you from making good financial decisions.
Okay, so we've talked about, all right, it doesn't, in the long term, doesn't matter so much whether it's Republican or Democrat. The party doesn't matter as much. And truthfully, that's not even something we can impact other than going out there and voting and being active in that sense. So if that's not something we can control and that's not something we can change, and realistically, that doesn't drive the markets, then maybe we should focus on what are those things that we can control? What are the things that are inside of our sphere of influence?
Yeah.
So that's kind of what we want to focus on. Instead of focusing on that which we can't control, let's pay attention to those things that we can control.
Yeah, after you've already made the decision on you're going to vote and you go vote, you really have no more control other than that. So let's talk about the things you can control that's outside the election cycle. And the first thing I think is important, Bo, is talking about basic portfolio structure and advice. And this is something, let me play off a scenario for you. We have received several calls. What's so funny is that we have received several calls in the last few weeks from different sides of the political avenue. Because we make a very hard pass at trying not to interject politics on the show.
Sure.
We do that with clients. So I think a lot of times clients will come and share their concerns with us, and they'll be on both sides of it. So it's funny when I think about that. What have we actually come across? Because what they're asking about is politics, but it's really better talked about when we're dealing with the difference in risk.
That's right. We think about, instead of trying to focus on where we are in the election cycle, we really ought to focus on your individual risk tolerance and risk capacity. And I'm reminded, Brian, of two conversations we've had previously with clients that were on each side of the aisle, just like you said. And what I think is so interesting is they called, and each one of them said the same thing. Hey, if so-and-so and their so-and-so changed, wins this election, I'm really, really nervous. I think that we're going to have problems. I think it's something we should be concerned about. I want to get your thoughts. I want to know how we should adjust. I want to know what we should change. And so we then had to ask the question, okay, do you want us to make a change because of the election, or do you want us to make a change because of where you are in your financial life cycle, because where you are from a risk capacity standpoint?
Yeah, and I thought that was brilliant. I was in both of these meetings with you, and I was like, that is a great way to look at it, because that is, the clients are typically calling for the short-term relief of saying, should we go add more cash? Should we take more risk off the profile? And what you came back and you said, look, I'm willing to do this if your plan calls for it. But if this is just because you want to check the box for the next 4 months because you're scared about how things are going, we have a problem here. And that's really a risk tolerance, exactly what you said, short-term issue. Risk capacity, which is taking more of your financial plan into place. So let's talk about more of how portfolio should be a function of the other parts of your financial plan.
Absolutely. It should be a function of where you are in your life cycle, what your specific tolerance for risk is, what the specific capacity for risk you can handle. If you're someone who's saying, hey, I want to make this adjustment, get to the election, see how it goes, and then want to go back, you're probably not making a solid long-term fundamental decision. If you want to make an adjustment, that's fine, but make it because it's a long-term adjustment, not a short-term adjustment.
Well, I think it's 2020. I mean, if you want to look for a silver lining and dealing with the pandemic that we're in, there is a big silver lining in the fact that we had March happen. We had the markets get beat up in a very short period of time. And then guess what? They've actually had their V-shaped recovery. Now, it remains to be seen. Do we stay in a V, or are we going to let, President Bush is going to get another W put on the scoreboard? I mean, it is one of those things nobody knows, but this is the perfect opportunity that if you went through March, through June, through July, and you're like, oh my gosh, I can't believe how bad the market was in March, that it was causing me sleepless nights. Thank goodness we have recovered. Use this moment to really reflect upon what is your why with your asset allocation? What is your why on what you're doing with your personal finances? and make sure that your asset allocation reflects that. If you did get very nervous during March and April, you might need to take this reset opportunity where the market has recovered the majority of it and go ahead and get that portfolio to reflect what you really desire and need.
Now, look, this is a hot take, all right? And this is going to be a little controversial. 2020 has been a great year. And this is why 2020 has been a great year. It's allowed us to see a market cycle much more quickly than we have previously. Again, if you look at the chart, from the S&P 500 dropped almost 34% from February 19th through March 23rd, which was a period of only 24 trading days. But if you go from March 23rd all the way through September 4th, it's increased 53.2%. Most often when we see a downturn and we get nervous, we get uncomfortable, we aren't given the benefit of having the market come all the way back for us to make an adjustment. A lot of folks make a bad decision at the bottom. So if you were someone who was, just like you said, in the first and second quarter thinking, oh no, what have I done? This doesn't feel right. You have a great chance right now, not because of the election, but because of where the market has moved to reassess where you are on the risk spectrum, where you are in your portfolio. We aren't often given that chance. It's a pretty unique opportunity in 2020.
Yeah, it does. It definitely gives you a measure twice, cut once on the risk profile. You can take into account years to retirement and how much liquidity. I mean, if you found that you were scared where your next dollar was going to come from, use this as an opportunity to make sure you have the appropriate cash reserves. All of this, I mean, look, if you take into account everything that has happened in 2020, we really have packed a lot into this year. And it is a great chance for you to go look at risk management.
Sure.
We've already talked about risk tolerance, risk capacity. What about disability insurance? What about job security? You're probably having more thoughts on that. Household income sources, retirement income sources in the future. All these things have come into play in 2020. This is the time to make sure that they reflect your why and you have a financial plan that actually is, is very proactive towards this stuff instead of waiting for the next bad thing to happen and you react to everything, because that is the wrong time to make adjustments in your plan. You need to be proactive. You need to be on offense with making sure your financial plan is right.
So if you were someone who didn't need to make an adjustment, did feel okay going through that, it's really, really interesting to see where we are now. Again, the market dropped 34% and then it made back 53%. Well, if you look at it, as of September 4th, the index is up about 40 points from its high in February, about 1.2%, or year to date, up about 6%. So even though it's been this crazy walk, if you stayed the course, and if you were someone who was dollar cost averaging into the market, and if you were someone who took advantage of strategies like tax loss harvesting, instead of trying to tweak your allocation at the bottom, then you are probably sitting in a fine place right now. That should just be a reminder that even though things may be crazy going on around you, if you have a good plan in place, that plan is good before the craziness happens, it's good during the craziness, and if you can stay the course, it will be good after the craziness.
A lot of times when you have chaos around you, you should just stand still.
That's exactly right.
I mean, that is so powerful if you can just understand that.